So with this budget, we are seeing a path for operational expenses to go down, but overall the deficit remains high. How sustainable is that?
Well, it's sustainable at a higher debt level. And so, yeah, we're not at the debt levels we were prior to COVID, which is like, debt to GDP was around 30%. Now we're around 42, 43%. But it is flat, it does flatline. So I think finance is saying today that when they do these longer term projections, it is sustainable.
Okay, and is that in comparison to other G7 countries that they come up with that conclusion? Because for Canadians to hear a $78 billion deficit in this fiscal year alone, it can be alarming.
It is alarming, but it's also like, how do you explain it? You explain it in terms of a very weak economy. So, on a year-over-year basis, the latest data that we have is, the economy is growing less than 1%, and this forecast, they're going to assume that the economy goes 1%, the unemployment rate will be above 7%. So in the context of that weakness of the economy, that you're going to run a deficit, and then because of this trade shock that we're dealing with, particularly the fracture with the United States, like there's a sense that we have to realign, trade infrastructure. And we have to take advantage of the innovation opportunities that are out there with respect to AI. And because of NATO commitments, all countries are experiencing these higher deficits.
All countries are experiencing a higher deficit, but when you compare us to other OECD countries or other G7 countries, is there room there for Canadians to take some comfort, or do they need to be concerned?
Yeah, there's comfort. There's always comfort, but there's on the other side there's some concern. The comfort that when we do, when the international agencies do these comparisons, we have the lowest deficit and the lowest debt to GDP ratio in the G7. And, that's pretty much true even across OECD economies. There's concern because I think, again, we are using deficit finance to spur this capital investment. And I think, like, going forward, are we going to make good investments? Is that going to contribute to growth? And we can't really answer that question. That's, right now we've got the strategy, but we have to see the implementation.
Look for the implementation. What about fiscal responsibility, though? Beyond how sustainable this is for Canada, in terms of this country, showing the international community any type of fiscal responsibility, is addressing the operational costs enough to do that?
Well, in this context that the budget presents itself in as this hinge moment for Canada, coming off many years of weak business investment, weak productivity growth, and now this trade fracture, this realignment of the global trading system. So I think in the context of that, we need this capital investment. We need to start moving goods and services more east-west than north-south, and that's going to come at an enormous expense, and that's going to take time to build. Which I think, one of the questions for Canadians is, can we wait? Are we going to be impatient with respect to this type of measure? In this sense, this budget is very different than other crisis budgets.
Build on that. How different is it?
So I think in 2008 we had a global financial crisis. We immediately went into recession. I think Canadians kind of understood that we needed to do something to protect households and businesses. For the most part, we protected businesses. In 2020 we had a global pandemic. And we basically told people to stay at home, and people said, okay, the government has to help us out. We bailed out households and businesses. Now we're dealing with a longer-term shock that feels like our sovereignty is being threatened, economic sovereignty. And we have to realign our economic relationships with other countries. That comes at a cost. And I think, so the government is trying to find the right balance. I think there were some people thinking we could have saw deficits closer to $100 billion. And now we see deficits peaking at 80 and declining to 65. And again, I think if we can get to an operating balance, and we could say in 2028-29 that the only deficit we're running in this country will be about $60 billion, about 1.5% of GDP, and it's all capital related. And then, here's the capital projects we're investing in. I think, if we can get to that point with this budget, if the budget passes, I think Canadians will feel confident about those numbers.
But in the interim, there will be a lot of pain. Is that fair to say?
Well, I think the pain is already being felt in terms of the affordability pain coming out of COVID with the higher inflation, particularly food prices relative to wages. I think pain is being felt with respect to the upward drift in the unemployment rate. And I think just, when we look at these business surveys that are produced by the Bank of Canada, the federations of independent businesses, we need something to spear growth. And, I guess the government is saying it's got to be capital investment.
So how would you describe then this budget? Prudent, wise, brave? How would you describe it?
I think it's transformational in the sense that we've never seen this emphasis on build. And there's been other budgets where we talked about we needed to build, our national defense, but for the most part we didn't do that. We kicked the can down the road. Here I think again we're actually, when you read the budget, it looks like almost a capital budget. We're getting pages and pages of investments on what is capital and what is operating, and we're getting numbers on cash and we're getting numbers on accrual. It's making us think a bit more like business people with the bottom line. So I think it's transformational in that sense. If we can have more budgets like this, it could have an impact.
Kevin Page, thank you.
Thank you, Michael.